Welcome to Energy Insights, your go to source for data driven analysis on global energy markets. Today, we are diving into the latest developments in oil, gas, LNG, and power, and why the current oil price surge might not be good news for demand. From geopolitical shocks to company performance, we will break down what the numbers are telling us clearly, simply, and with actionable insight. So stay tuned because what you are about to see could reshape how we think about energy markets today. So let's dive into our segment one, which is what's happening in the oil markets. So our segment one will cover this part. So the Iran related conflict has triggered major supply shock across the energy system of the world. At the center of this disruption is the Strait of Hormuz, a critical route through which nearly 20% of the global oil supply flows. With rising geopolitical tensions, results in shipping risks are increasing, insurance costs are rising, tanker movements are becoming uncertain. Oil prices have surged sharply with Brent crude trading above 110 to 120 per barrel levels. But this is not demand driven. It is geopolitical premium being priced into the market. And that distinction is critical because it sets the stage for what comes next. In our segment two, we are looking the government's response, particularly the G7 response. So, how are the global powers responding to these crises? The group of seven, which is normally termed as G7, has stepped in with a clear message. They are ready to take all necessary measures to stabilize the energy markets, and this will include uh, coordination, release of strategic oil reserves related coordination, similarly, close coordination with the International Energy Agency, emergency fiscal measures to protect consumers. One major step under consideration is the release of hundreds of millions of barrels from the emergency reserves. At the same time, they are also looking towards the fuel subsidies, tax reductions, financial support programs. These are being deployed globally. So, this is no longer just a market issue, it is now a policy driven energy crisis. But here is the limitation that government can influence supply, but they cannot fully control demand. And that's where the real shift begins. Similarly, under the segment 3, we are covering the market signals where the demand destruction begins. Now, let's look at what the market data is telling us. Across the energy complex, the snapshot is that the WT crude oil traded above $102 per barrel, and which is an increase of 3% from the previous day record. Similarly, Brent crude traded above $113 per barrel. Gasoline, gas oil, and heating oil all were at a rise level. This confirms the supply shock is spreading across the value chain. But here is the key signal: not all energy prices are rising. Natural gas in the United States is down more than 5%. This divergence is critical because when oil rises but gas weakens, it often signals that the demand stress, slowing industrial activity, and changes in consumption pattern. So the market is shifting from supply fear to demand concern. And this is how demand destruction begins, particularly price rise, behavior adjusts, and demand weakens. And when what happens, such things, then the market instability follows things. In segment 4, we are looking to the major energy companies. Now look at how this impacting energy companies across the oil, gas, LNG, and the power using the latest market analysis. In the oil majors, Saudi Aramco with the market cap of $107 trillion. Similarly, ExxonMobil 650 billion plus with the market cap. Chevron with $400 billion plus. With oil above $100 per barrel, profit margins are extremely strong for these oil majors, and cash flows are significantly elevated. But in case of the gas and LNG players like Shell, Total Energies, key signals are that LNG demand remains strong globally. Long-term contracts are stable, but spot gas markets are diverging. And US gas prices are falling, European gas prices are rising. This reflects regional demand difference. In the integrated energy companies portfolio, diversified players like the Shell and Total Energies are best positions due to the oil profits, LNG stability, and risk spread across the portfolio. Diversification is acting as a hedge for these entities. In case of power and utilities, the Nextra Energy or the EDF or the Enel current radar that the rising fuel costs are putting pressures on the margins, and policy support become critical. Renewable energy heavily utilities are more resilient under the circumstances. So sector-wide signal is that across the full energy value chain, in case of oil, the expectation is strong profits and price-driven upside. Similarly, in the case of the gas and LNG, the current signal is of mixed, and also highlights the regional divergence. In integrated energy companies operating on both sides, on the oil and as well as on the gas side, so mostly stable performers are there. In the power case, cost pressures are there, and they are also policy dependent, particularly due to the high fuel cost, input fuel cost. But the key risk is common for all the energy entities, either it's power, it's gas, or it's LNG, or it's the oil. That's the demand uncertainty. So the takeaway is clear from Energy Insights for today's episode. This is not just an oil price rally, it's a system-wide energy stress scenario. Supply risks are putting pressure on the prices to be on the higher side. Similarly, demand pressures are pulling the system down, and when these forces collide, the real impact is felt across the entire energy and the global economy. So this is all about our today's episode. If you found this video insightful, make sure to like, subscribe, and hit the bell icon to stay updated with the latest energy analysis. Thank you for watching Energy Insights.